Good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Veron. It's my pleasure to introduce this new session of the Financial Statement Series at the Peterson Institute for International Economics. And today, not for the first time, probably not for the last, we're going to talk about central bank digital currencies, CBDCs. CBDCs have been talked about a lot in the last few years. Often it's been a bit of an abstract consideration. It's getting a little bit more concrete, not to say that we're in the midst of actual use of CBDCs, that is still some way off, whatever CBDCs are, but at least we are seeing more precise blueprints or more precise ideas of what they might be. And there was an important paper in February published by the Bank of England. So that will be the starting point of our conversation. For that, we have Katie Fortune from the Bank of England. She's very much in charge of that at the bank. She studied mathematics and economics, the perfect combination for CBDCs, at the University of Cambridge, where she graduated in 2006. She's then worked a little bit for the private sector in the Brattle Group consultancy in Cambridge, Massachusetts. At the same time, studied economics at Birkbeck, University of London, and in 2011 joined the Bank of England, where she has had several positions in financial stability, prudential policies, monetary policy. She's worked with John Cunliffe, who has spoken in this series. She also went out of the bank for a few months in 2019, 2020 to work at JP Morgan, also on their projects that are related to the kind of technologies we're talking about and of banking, opening up banking services in the UK. So we're very much looking forward to not just the explanation of the February paper, but also an update on all the things that have happened since then. Sina Krogstrup, who has already also been a speaker in this series, is, of course, one of the governors of the National Bank of Denmark. She studied economics at the University of Copenhagen in the 1990s and was at the University of Geneva. It's a graduate institute and with a PhD in economics in 2003. She then worked at the United Nations, at the UN Conference on Trade and Development, UNCTAD, and at the Economic and Social Commission for Western Asia in Beirut, which is a more on-the-ground experience, to say the least. After that, Sina has worked at the Swiss National Bank, where she stayed for nearly a decade. She's also been a lecturer in Geneva at the Graduate Institute, at the University of St. Gallen, at ETH Zurich, and I should say, most importantly, towards the end of her stay at the Swiss National Bank, a visiting fellow at the Peterson Institute for International Economics, which she also complemented with a few months as a visiting researcher at the Federal Research Board. And from 2016 to 2019, an advisory position at the Research Department of the International Monetary Fund in Washington. Since June 2019, Sina has come back, not to Switzerland, but to Denmark, her home country, where she's been an assistant governor and now one of the three governors since November 2020. With that, Katie, over to you.
Thank you very much, Nicola. I'm going to share some slides and take you through, as Nicola says, the paper that we in the UK published in February of this year. Let me just put it onto full screen, and then someone can tell me if I've failed. Okay, so I'm Katie Fortune. Nicola's given me a very kind introduction. You'll notice I put both the Bank of England and HM Treasury, our finance ministry's logos on here, not because I represent them both. I certainly represent the Bank of England, but because this work has really been done together in parallel. We published this paper together. And so I do want to make sure that that's really clear. Some of this goes beyond central bank competencies, really. So I understand you're a literate audience and you probably know this, but let me just start with a little bit of context here. The use of cash has been falling really quite rapidly in the UK, and there are new forms of digital money starting to be used, in particular stable coins. Now, money, it doesn't, these changes aren't being driven by the forms of money. The forms of money, I would say, reflect how our lives are changing. Our lives are becoming more digital. Money has always evolved to reflect the lives we lead. And one thing before I move on to talking about CBDCs to say is that as we've seen this fall in cash, we haven't said, oh, well, we're all becoming more digital. We have said there are people to whom cash is really important. And we have made moves to ensure, to say the Bank of England will continue to supply cash for as long as there is demand for it. So that's pretty important to say here. What we're looking at in the future is a mixed ecosystem, not a replacement. But in this context of changing money, we at the Bank of England, along with over 100 other central banks, have been considering central bank digital currency. I won't go into this diagram except to say, what is a central bank digital currency? It's a retail central bank digital currency. That's what I will talk about here. It's a form of money that is available to individuals. It's issued by the central bank and it's electronic. And there are forms of money that have two of those three today, but all three, that's where CBDC comes in. So in February, the Bank of England put out these major publications jointly with the Treasury, a consultation paper, and also a technology working paper to go alongside that. I'm going to talk about that consultation paper. It covered both the rationale, why we think a CBDC, what it could provide in the UK, and also the high-level design that's proposed in there, the model, what it means for data and privacy, and what that user experience is. But before I turn to that, the really important thing to note is the headline there. The headline being that CBDC, a digital pound, is likely to be needed in the future. And there's two things to draw out there. Likely to be needed. No decision has been made in the UK, but there is a view that it could be. In the future, this is a really forward-looking assessment. So let me turn to the consultation paper. I'll start with these motivations, this rationale. So the first, there are two that we consider sort of primary here. And the first is around the role of money. Money is an anchor. Everybody uses the same money. It's a uniformity. That's what makes it money. If I buy something from you using money, you know that you can turn around and buy from someone else using that same money. There needs to be that certainty that we're all using the same thing. And after that, we get to ignore it. You know, it's not a thing in its own right. It makes transactions work. And the central bank money is really an anchor of that confidence in the monetary system. In the UK, as in almost every country, the central bank has issued paper banknotes for centuries. And that has provided a bit of a bridge, a sewing together of the different forms of bank deposits you can hold. I can always go to an ATM and take out my money in central bank cash. And the question is really, is there a need for a digital equivalent to that bridging asset that all forms of money can recognize its uniformity across the system? The second pillar is around this promoting innovation, choice, efficiency, competition. The central bank needs to constantly evolve to make sure it's supporting today's economy, tomorrow's economy, not yesterday's. Is there a need to update the infrastructure that we are providing to ensure that end users continue to see choice in payments? And so those are the two pillars. If I refer to pillar one or pillar two, that's what I'm referring to, the role of money and that promoting, sort of supporting innovation. So with those two motivations in mind, the paper sets out a high-level model, three aspects: the model around data and privacy and around the user experience. And I'll just talk about each of those very briefly. So on the model, what we propose is a platform model. The central bank, the Bank of England, provides the ledger, the core ledger, the infrastructure. And then there's an API layer that allows the private sector, the regulated private sector, to connect to that. And that private sector provides the wallets for end users to be able to hold digital pounds. Now, the important thing to say here is each is playing to its strengths. The public sector providing that natural monopoly, the payments ledger, the infrastructure, the private sector doing that user-friendly, user-facing end. That is the layer that we expect to see innovation at. It's not the central bank that's going to provide the innovation. An important thing to note about those intermediaries is that it's pass-through wallets. They aren't holding the CBDC. They are just giving you the end user a view through to your CBDC. And that's really important for both those two pillars I talked about. That certainty that it's central bank money, it stays with the central bank, but supporting innovation by being, those intermediaries could potentially be very lightweight companies. They don't hold that balance sheet that a traditional bank would. And I will come back to that API layer at the back, that really important layer that allows those two layers to communicate. The second aspect of the design around data and privacy, and here the headline really is private but not anonymous. And really a good comparison here is your bank account. So we can't have it be totally anonymous. Digital money is very frictionless. The reality is there's illicit finance, there's fraud, etc. There needs to be identification to enter the system. But just as with a bank account, you would expect privacy, and in particular, privacy from the Bank of England or from the government. And that's what that model that I set out allows for. It is that private sector layer that would deal with identifying the customer and sort of ensuring AML rules, etc., are seen to. So the bank and government would not have access to Digital Pound's personal data. That comes with the same caveats that your bank account does, that under certain circumstances, if there's evidence of criminal activity, that data can be released. But under general circumstances, no access. And finally, a real aspect of this that's aligned with sort of wider UK strategy is that desire for users to be in control of their data. And here's about us being supportive of that. So what I mean here is, we don't want to say, no, the private sector can't use your data. What we want to say is the users should be able to choose how much data to share, that they should understand the value of their data, that they should say, no, I want a highly private version is an option, but they might also say, well, you are providing me additional service because I share my data. I understand that that's being made clear, and we do want to be supportive of that real understanding of the value of your own data and what you can get from it. So the third aspect of the design, just the user experience. Now, this is pretty straightforward. What we're saying is this is an everyday payments mechanism. And so here it really, whereas before I said that bank account might be a pretty good analogy, here cash is. You want to be able to make everyday payments. There won't be paying any interest. You need to be able to easily move between different forms of money, really supporting that pillar one. So between cash, between your bank deposit, between stable coins, digital pounds. We have said that at least initially there would be a limit on how much you could hold, and that's to do with that financial stability risk that a lot of people have identified. So that's what the paper proposes. As I said,
sorry to interrupt Katie on this, but you have given an indication of how much the limit might be, right?
We have said £10,000 to £20,000. That is a significantly higher number, people will be aware, than the European Central Bank has discussed publicly. I'm very happy to talk a little bit about what I see as sort of maybe the different, we've both gone into it, as central banks, deeply aware of the financial stability risks, deeply concerned about them. That comes naturally. But I think we have a slightly different, probably mindset as we're looking at it, which is, I've described it as a payments mechanism, an everyday payments mechanism, but we don't see it as, oh, I'll put a little bit of money into my CBDC account, my digital pound account to make a few payments. It is more I could have my wage paid into my CBDC account if I wanted to, and that is how we've seen it as a sort of a more holistic thing. And so that is how we have calibrated that proposal. I'm very happy to talk further about that, but I'll continue just to whistle through the rest of my slides. As I said, alongside that consultation paper, the Bank of England put out a technology working paper that sets out these foundational considerations. They're really about supporting the policy decisions, about supporting the trust, the security, the resilience of the system, and importantly, around energy usage, aligning with the net zero policies of the UK government. So that's what the consultation paper said. I'm just going to spend 2 minutes on what next for the digital pound. The consultation paper marked a move from a research and exploration phase, something you could say we've been in for many years, thinking really hard about the abstract. And as Nicola sort of launched us with, moving into a slightly more tangible, what's the design? How can we flesh out this design that we've put out there? So we intend to flesh out a blueprint, and do that alongside the private sector and the third sector, working with external parties. I don't see this as us going quiet. This is us going to be the beginning of an ongoing dialogue. Now, phase 2, this design phase, is not a build phase. There would have to be a decision to move into a build phase. And the main thing to say here is the design phase has value whether or not a decision is made to move into the build phase. And so this is by no means a preordained decision. I could speak for a long time about the design phase, but let me just say 2 things. The first I would say is CBDC, the digital pound, would be an ecosystem. For an ecosystem to work, you need everybody to want to be involved. So that's the central bank issuing the digital pound, those intermediaries providing the wallets, and then those end users using the digital pound, individuals, businesses. There needs to be an incentive for everyone to want to be part of the ecosystem, for an ecosystem to work. And I would say that our concentration during this research and exploration phase has largely been on those public policy objectives. And what we will look to do over the design phase is really move it. We haven't ignored end users and intermediaries, but I think they will become much more important. What does it need to be as a product for them to want to use it, which is how you will deliver on those public policy objectives. So really, I think we will be doing a lot of work with the potential intermediaries with understanding how end users might use this. And so just a nice little example, a couple of weeks ago, we published a report, us jointly with the Biz Innovation Hub in London, about Project Rosalind. And this just draws on 2 things from my last 2 slides. One is around developing the intermediaries and the use cases, and the other is about working with the private sector. So Project Rosalind developed that API layer, a prototype for that API layer that I mentioned when I was talking about the model. And it did a couple of things. One thing it did was demonstrate that API layer can be agnostic of what's going on underneath. The technology could be centralized, it could be distributed. The API layer can sort of provide an agnostic layer. But the other thing we did was work with a lot of companies to develop end use cases using those APIs. And that is the start of really developing this idea of what would intermediaries use it for, what would end users use it for. And so a nice report came out a couple of weeks ago to really start sort of illustrating how we're trying to think about that.
Okay.
I'll stop sharing.
I noted that for innovation, you had a very nice little picture of the Brussels Atomium. So I took that as an indication that the Bank of England is very connected with its continental counterparts. This aside, Sina.
Yes, thanks very much. So very interesting project, Katie. Thanks a lot. And I would have many questions, so I hope that we can address all of those during our time here. Just to say that I'll not comment directly on this proposal, but give you a sense of where we are in Denmark. We stand quite differently on this. We follow very closely all the work that's happening on the development and projects around CBDC, and it's all extremely interesting. And I think we're learning so much these days. We nevertheless in Denmark, we don't currently pursue plans to introduce a CBDC, or you can call it digital kroner. And that is for 2 reasons. We don't currently see an added value to the system that we have. And secondly, when you look into the future and to address future challenges, as you also mentioned, Katie, we see that there are challenges that can come up. We don't see the issuance of a CBDC in Denmark as the best response to some of these solutions. But it is an area that we follow quite closely, and we are also keen on learning and will adapt our view as things change. On the first point, just as the UK, Denmark has been really on the forefront on digitalization and really also on the economy in general. I think Denmark is one of the most digitalized economies in the world. And that is also seen in the space of money and payments. We were some of the first to introduce a digital RTGS system. We were also very fast with mobile internet banking, mobile banking, instant payments. We had our first instant payment system in 2014. I think the UK we were competing with the UK and being amongst the first on all these things. We also have a lot of financial inclusion. And our payment systems are, for this reasons, they're cheap, they're efficient, and they're functioning very, very well. In addition to this, we have a high level of trust in the monetary system. We have a high level of trust in money, in privately issued money in Denmark. And that is despite of the fact that we are probably also one of the countries where use of cash in payments has gone down the furthest. And that's not a policy choice. It is simply by demand. So citizens elect to use privately issued digital money for payments in Denmark. And how did we get here? How did we get to a system that works so well? Well, it has been, I think the trust in money is not, in Denmark, we don't see trust in money as linked to the issuance of CBDC or issuance of central bank issued money that citizens can directly use. So cash currently and what could be substituted with CBDC. We do see the trust in money as related to trust in institutions that ensure financial stability, price stability, regulation. We think that it's very closely aligned with deposit insurance. I think Danes do not question whether their money in banks is safe. And that is because of all these reasons and not really linked to whether they would be able to take out cash or not. And then it's very important that banks that issue digital private money, they are, of course, hooked up to the central bank, and they do have access to our crisis lending. And we see our wholesale CBDC, so bank deposits at the central bank is for us. If we have to talk about a monetary anchor, that would be it. But we think that all these other things are part of ensuring trust in private money. And even as cash goes down further, we have no plans of phasing out cash. So cash will continue to be there, but it is going down in use. Even as that happens, we see absolutely no reason to think that would be in itself triggering distrust in private money. So that's not a reason for us to consider CBDC. There has been, we have introduced these, we have been very good at innovating and introducing retail digital payment systems that are safe and efficient and cheap. And that has been done in Denmark by private, that's been in private hands. So we as a central bank, we have played a role. We have been playing a convening role. We have been pushing in certain directions when needed, but it has really been the private sector banks that have developed the retail payments infrastructure. And this is something that we see as desirable because we don't think that we as a central bank, a public institution, that we would have the competencies to be competing with private service providers. There is, of course, it's another reason why some would consider CBDC, and I think that's also part of what you mentioned, Katie, is that there is a concern that in payments there are clear network effects and there are very, very clear scale effects. So we have a tendency, if you just let market forces play out, there will be a tendency for very strong centralization among very few providers. And that's also what we see currently, and that's also what we've seen in Denmark. That is very difficult to avoid. And the approach that we have had in Denmark and that we continue to think is the first approach to this is supervision and regulation of payments service providers. And currently that is at the EU level. There is a regulation of payment services. There is regulation of fees in payments. And if there is a problem with competition, we think that that's the first place that we should be looking. And that is the approach that we currently have in Denmark. Okay. So maybe I will stop here and say that just to sum up that so we don't have, as I said, we don't have current plans for introducing CBDC. We are very closely following what's going on around us, and we are learning a lot, and we are also ready to change our views on this. And before I stop completely, am I allowed to ask a question?
Go ahead.
So So I will start off the questions, because I was so intrigued by the role that, Katie, that you give to this interesting proposal with the API, and it seems to have a very central. It's a central part of the proposal, and it looks like a platform. Now, I'm not into the tech, so I cannot discuss the technology on denying that, but it seems to be a platform that then you could build innovation on top of. But it makes me curious as to what is the CBDC part of the tech in this, or we can divide the current CBDCs that we're discussing into two parts. One is that it is issued by the central bank, so it is a store of value in the sense that it's kept on the central bank balance sheet. It's a claim on the central bank. And the other part that everybody attaches to this is a payment system. That's also how the ECB speaks about their plans. And here, I think there's a very important role is this API that you're mentioning. And I just wanted to ask you if you could say a few words about whether these two parts of your CBDC, whether they can be separated, and what is the important driver of addressing the problems that it's supposed to address? Is it the technology and the API part and the payments part, or is it the role of being on the central bank balance sheet?
Yeah, absolutely. So I think we would say that a digital pound would be both an asset and a payment system. That API, but what we would want to do is keep that as simple as possible. The API layer allows you to initiate a payment, to open an account, to initiate action on that core ledger. But what we've seen, we've done a bit of work into how can central infrastructure support innovation, and the answers we're coming across is keep it very simple. And so that's why I was saying anything in terms of innovation would come because that private sector layer would be developing on top of those APIs. That's absolutely right. So for us, the technology very much follows the policy. It's not a technology-driven project. It's a policy-driven project. Nicola, I don't know if you would like me to come in at all on the rest of what's been said, or whether you have some questions.
Let me start with a few questions. One thing that will be of interest to our audience, of course, is the international connectivity of all these projects. So you mentioned the quality of the interaction with the European Central Bank. Can you tell us more about this, and particularly as the pound is one of the world's great reserve currencies? You know, how do you work with the Fed? How do you work with the ECB? How do we work with the Bank of Japan and others in this project?
Yeah, we've got excellent relations across central banks on this topic, and we do have a group convened by the Bank for International Settlements, the BIS, working on CBDC, and that cuts across sort of all the countries you mentioned, but also Sweden, Canada, Switzerland. I probably missed someone.
Not Denmark.
Sorry. And so we discuss a lot the policy issues, the big issues. I think it is likely we'll just as all these projects are starting to move into more sort of getting into the, not quite the weeds, but at least down from 100,000 feet to 10,000 feet. We will be, you know, inevitably our conversations will change. But when it comes to cross-border payments, that is actually being discussed a lot, not just in CBDCs, but across all payments at the G20 level, the CPMI, etc. And we've been an active part of that conversation. One thing I would note with that conversation is they had a series of building blocks about improving cross-border payments. There were 19 of them, and building block 19 was around CBDC, and 17 to 19 were about new forms of money. Those in themselves will not solve the issues that building blocks 1 to 16 are looking at. You know, the differences between opening times, AML standards, etc., between countries require a lot of conversation across countries. The good news is that conversation is happening, and CBDCs offer us an opportunity to to start from scratch, you know, that we are, a lot
Right.
of us at pretty similar levels, but I don't think it's, I see it as probably still a reasonably long-term project.
That's right.
We start
and
today.
on the,
Yeah.
on the payments initiatives that you referred to, I cannot help mentioning that nearly a year ago in August 22, this series hosted Tara Rice, who is in charge at the Secretariat of the Committee on Payments and Market Infrastructures in Basel, on precisely that issue. But it is not just about CBDCs; it's about fast payment systems, and the sense I got from it is that indeed a number of jurisdictions view fast payment systems as a more urgent and more maybe relevant point of focus than CBDCs. And in my previous question, I mentioned the US, of course, because there is not really the equivalent project of a CBDC in the US as there is in the UK, or for that matter, in the Eurozone. So any comments about that?
I mean, I think the US has put out a lot of great work. The project doesn't look like the Digital Euro project or even the Digital Pound project, but I think a lot of the countries we speak to are at a very similar stage, in the sense that they have not committed to doing it, but they're putting a lot of effort into it. But then when you get a bit deeper, what that looks like in practice is a little different across these countries. And we've seen today the digital euro is definitely pushing forward quite quickly. In the US, I think they've done some impressive work, their collaboration with MIT, for example, but the policy position is certainly far less developed, it seems to me.
So Sina, you're of course not in the Eurozone, God forbid, but you're pegged to the Euro, so you follow it closely. Can you update us on the latest about the digital Euro? Because there was an announcement in Brussels this morning about the legislation. What is the actual timetable? So ECB has said it would announce a decision in October, but when will we see things moving the way they are moving in the UK, or maybe not?
So I cannot speak for the plans ahead, but I can confirm that a first draft of a legislative proposal for the digital euro was shared today. That's not a final draft. That's a draft that they will have comments on, and we're also we're looking at that. We haven't gone through it fully yet, but we will be looking at that very closely, and we will be very interested in that. And I think the timetable that is planned, and that certainly can change, is that by the earliest 2025, there will be a final legislative proposal. And that should enable then the ECB to go ahead and make a decision on whether to move ahead with this project. And from now till then, I'm sure that all the analyses and all the projects and the development will be continued. But of course, it's not, the ECB says the same as I hear from the Bank of England, that the decision has not been made yet, but it will be coming up.
We have a question, Katie, from James Carnes on the API. Is it the Bank of England developing the API, which I think means application program interface, if I'm not mistaken, or is it the National Standards Committee?
So nobody yet, but it will likely be, I would guess, some kind of group convened by the Bank of England, but bringing in others. And what we have heard is that as far as innovation is concerned, when we talk to smaller players, the more we can standardize, actually, the more that does open. So the more we can align with the likes of the open banking standards in the UK, etc., that would really help. But we aren't quite into developing the actual APIs yet. The Rosalind project has enabled us to sort of play with the ideas.
Yeah, the Rosalind project is not an actual future API, right?
No.
We also have a question about the limit. You mentioned the limit above the ones that have been broached by the ECB. One of the attendees is asking how that would be enforced since you don't collect personal data. Is it an aggregate wallet balance with multiple payment service providers? How is that supposed to work?
Yeah, no, it's an excellent question, and it is something that we are working through in this design phase. I think we won't receive identifying information, but that's not to say we won't have some ability to see, a balance, say, potentially. But I think there's actually a really big range of how that could be enforced, and that is actually to be worked through. So, for example, in the UK, there is a limit on how much you can hold in an ISA in any given year, pay into an ISA. Now, that is actually managed by self-declaration. Or you could have an automatic, there's a cap on how much you can pay on any contactless transaction, and it simply won't, if you accidentally tap when the amount is more, it just won't let you. So there's a range of ways of actually implementing that. That is one of many questions that we are looking at right now.
So there's a question from Steve Kamin, who used to work at the Fed, on the non-resident use. So let me take the question in a narrow sense, and then we will broaden it up to emerging markets. But Steve is asking whether non-residents will be able to use a digital pound. You said yes, within limits. So what if somebody, he says, from Argentina, wants to pay another person in Argentina with digital pounds, both have digital pounds in their wallets? Can this be prevented? Is that a problem? Can you give us a little bit more about the thinking in the paper and beyond about that?
Yeah, so you'll know, but let me just make clear. In I'm going to get the year wrong, so let me not start like that. When the UK held the presidency of the G7, it developed these principles around CBDC, and one of those principles was to not impinge on other countries' monetary sovereignty. So we do, and we're fully signed up to those. So the example you've given there is something that I think we would start to be a bit nervous about. But having said that, we also we don't like the idea of limiting, applying sort of discrimination in access to this. So
that sounds like a circle to be squared, right?
It is absolutely a circle to be squared. That is, any number of these questions, precisely that. I think one thing that we will see is that for a non-resident to gain access, they would still need to either meet the KYC requirements of a British intermediary, or have a recognition agreement between the UK and a third country around recognizing each other's wallets. And so in working out those systems, I suspect we will have to come across this question about what does it mean for other countries.
So we have a bunch of questions about emerging market issues, and maybe to you, Sine. Angel Enrique Nader asked about CBDCs and fiscal dominance. Would they contribute to reducing fiscal dominance in the countries that has a lot of that historically, like Argentina? Aline Bronzati asks about multilateral organisms having emphasized Brazil and Latin America at the forefront of CBDC initiatives. So a general view about what's happening in the region. And Sebastian Katz is asking about the risk of digital dollarization, which is a bit what we just discussed, in case an issuer of a global reserve currency goes ahead with CBDCs. So especially as you've been at the IMF in a number of places where you have really focused on these cross-border considerations, are you concerned? Do you think central bankers will never allow this kind of slippery slopes to be there? How should we think about both the risks and perhaps the opportunities to discipline countries?
So that is a very good question. So the types of CBDCs that are being considered now, they are all considered with a strong cap. So we just discussed the size of this cap that from the UK, which is relatively high, but it's nevertheless there. And the proposed or the suggested cap from the ECB is a bit lower, 3,000 euros. And there are good reasons for this, because there are concerns that if you offer a CBDC without limits, then you could have the risk that during times of stress in the financial system, that you would have, this would facilitate a flight away from bank funding and towards the central bank balance sheet. If these are the types of CBDCs that we are considering broadly, then and the caps are relatively small, and I think that some of the caps that we are considering now would not affect the banking sector hugely, then they also shouldn't have big fiscal implications. Of course, I can't speak to the fact that if you introduce an unlimited CBDC, and of course it would have completely different implications, because it would increase the central bank balance sheet, and it would have fiscal implications. And how you would use that for disciplining fiscally, I think that is an institutional design question. Whether that would be if you would want to do that with this type of instrument, then you would have to design it in a certain way. So I don't think that's inevitable at all. There was a question about regional developments, and could you repeat that?
No, well, it was more about Latin America. I mean, I took it as more about Latin America as a place where there has been a lot of experimentation, but maybe I misunderstood it. But maybe we can also expand it to the experimentation that has happened in Central America, in Africa, in some Southeast Asian countries. I'm thinking of Cambodia here. Have we learned anything really useful for, say, convertible currency space from those experiments? And what is your? I mean, the take-up has been typically relatively low, as far as I know. But what are the lessons learned so far from the kind of early starters?
So I cannot claim to have studied this in detail. I'm also aware of the fact that some countries have introduced this, and I think that I know the same as you do, Nicolas. That the lesson that we hear about is that pickup is relatively low, and that and I think that that's one of the key concerns from our side, is that when you develop something that is used for payments in competition with private initiatives, then there has to be some reason for citizens to want to use it. And in particular, in the case of Denmark, when we already have very good alternatives. And I think that that's what we see from some of these cases, is that just because the central bank issues some of this, you cannot be guaranteed that it will be used. There has to be a good reason. There has to be convenience. It has to be cheap, easy to use, and has to be competitive to other means of payment. So I think that is the lesson that I know of, but I won't claim to be in the details of I'm sure there are very big differences across these countries, in both in motives and in designs and in ways they have done it. And I can't comment on that further. On the
go ahead, Tina.
Yeah, on the risk of currency substitution. So there are two more points that I wanted to mention, and one of them was this. On the point of currency substitution, this is something that we have always had on our radar screen in Denmark, because we have as you said, we have a fixed exchange rate against the euro, and we have very high level of integration with the euro, and we do not have any capital controls, and so there has always been a bit of an eye to whether we would see dollarization or so-called euroization in Denmark. And the fact is that we have, you can be surprised or not, but we haven't seen that happen in Denmark at all. And should we now be worried when other central banks issue these types of currencies? Or there's also a worry that private global financial institutions or big tech or whatever institutions would build some, for instance, DLT-based new currencies. Should we worry that we will have currency substitution with various drawbacks for countries? And of course, I think that this should always be somewhat of a concern, but we know from history. I mean, this is not a hypothetical thing that can happen in the future. We know from history this has happened often in many countries, and it has almost invariably been linked to countries that have had monetary and financial systems that have been unstable, where there hasn't been a high degree of trust in the domestic currency. Very often we have seen countries where there is a high level of inflation, perhaps because there is countries with fiscal dominance. And we do see that from our perspective, the reason why we haven't seen, for instance, currency substitution in Denmark, and we also don't think that that's going to happen in the future, is because of a very keen attention to price stability, financial stability, safe and efficient payment systems. Because when you have a system where there is trust and good payments, there is not a lot of reason to substitute away.
That's right.
And maybe another point is that
Yep.
Yeah, there is also the whole question of resilience and robustness. So we do have, I mentioned the problem of payment systems tending to converge toward a few big actors, and that this is a competition, a problem for competition that we see as a problem for competition authorities and also for regulation. There is also a big focus on this, and I think that that's very important to look at. More and more in these years, there is a focus on this because there's a concern about resilience of these payment systems. If you just have one or two big providers and they are active in many countries, then there's fragility in the system if these providers, for some reason, stop operating. And that could be cyber risk. It could also be geopolitical issues. And this has also been raised as an issue that we need to address. And here, what we see is that there is definitely a need to pay strong attention to robustness and resilience and perhaps de-risking of payment systems. And again,
I think at some point the Bank of Finland has encouraged Finns to take some cash out of the ATMs just in case at the peak of the uncertainty about the Ukraine invasion. Is that an argument actually to keep cash in the habits of populations?
So in some countries, they see cash as part of as the first defense against the geopolitical risk, for instance, in the payment system. And this is something that we also look closely at in Denmark, and perhaps it could help. But we think that the cash ecosystem currently, the way that cash circulates through the economy, is fully electronic, fully digitalized. And so if you have situations where it is where we have a catastrophe, where we have a question of electricity, then cash is also not going to be the first line of defense. But cash could, of course, be an alternative in case a specific payments provider is not going to be operating anymore. But we would need a lot of cash in the hands of almost everybody for that to be a viable option for very long. So we think that that should not be the main solution, the main way of de-risking payment systems. And so we are looking, of course, closely at whether we can have additional payments rails, retail payments rails, in addition to the main ones that we see currently, for instance, in Denmark and the euro area.
Right. Katie?
Have you got a specific point you want me to come in on, or I can respond to what I've heard?
Well, initially I wanted to ask you about the foreign experiences, especially in the emerging market space. But Tine has brought so many new issues on the table that you can pick through them. We're getting unfortunately closer to the end of the session, and there are more questions from the audience. So if you can keep it relatively concise, because I'd like to go through a few more questions.
Absolutely. So I'm very much aligned with Tine in that when it comes to these fiscal issues, what we see is that it's the switch from the introduction of a digital pound is not the fundamental issue here that would drive it. It's the rule of law. It's the stability, the monetary, etc. These factors that exist today. But I would emphasize that everything about our own assessment is about this forward-looking aspect of it. And so, yes, there's trust in banks today. I agree, as much as sort of there's plenty of moaning about them, there's also a great deal of trust in them. But I think it is quite easy to look at big tech or some of the innovations that certain technology developments bring in and say, well, they might be providing something that users want to use. And as Cean said, if you're providing things people want to use, that's when they will use it, not because you want them to use it. And in a forward-looking sense, there is potentially a sense that people might start to be using stuff that is much harder for us to regulate. Firms that aren't banks or aren't sort of strictly payments focused, etc. Now, our vision is certainly not that the CBDC would be the dominant form of money. It's part of a mixed ecosystem. But whether as part of that, it is one of the sort of aspects that helps to maintain the things that we trust. That's the sort of question for us, rather than whether we need it today. I can talk a little more about some of the whether we need it if that's wanted. But as you say, you've got other questions, so let me.
Well, one of the things is, there's a question from Dan Fihmi on, sorry for the mispronunciation, on stablecoins. There's a question from Sergio Urias on cryptos. There is an expression of skepticism from Ted Truman on the use cases, and from Gonzalo Pascual on the fact that the CBDC withholding limits doesn't change much. I'm struggling to get a sense. I remember in 2019 when Facebook announced Libra, there was this feeling, oh my God, the private sector money will displace the public sector money, we have to react. Now we're in crypto winter, as they say. These private sector projects have not taken off the way it was perhaps expected by some of their promoters. So is it your impression that we'll have a number of years without that kind of pressure again, or is the pressure really there to have a response to private sector initiatives for central banks?
I'd never vote against the private sector, and I think it would be a mistake to wait until something is on our doorstep before we react to it. So we are trying to make sure that we're considering whether this is one of the sort of tools in our toolkit, essentially. I think these things are still being developed by the private sector, and the thing we wouldn't want to the world we wouldn't want to end up in is that I'm a company A type of person and you're a company B type of person, and therefore you and I find it hard to transact between each other. And that's the thing that we would want to, that's that real pillar one aspect of what I was talking about.
Sina, are you effectively betting against the private sector?
I am also not betting against the private sector, but I do think that if the private sector developed something that we want to use as money, then that thing would have to have stable value. We would have to trust the value, and it would be in terms of somehow of our living costs and our claims, and also our obligations, our mortgage, our income, something that is anchored in our cost of living. And this is why the cryptocurrencies that are unanchored, I think that is, I don't think we should expect that to somehow become money organically in our societies, because I do think that they are way too volatile. So I think we're thinking about something that looks like stable coins, or now there's a lot of talk about tokenized bank deposits, and what all of these things that we could consider could become money, could become something that people would both want to use for payments and storage of value. They are somehow linked back to the unit of account that we have in the countries that we're operating in. And we in Denmark, we feel very confident that we control that unit of account. That's the Danish krone. And so if we have a stable coin that develops, and that would be coming into Denmark, and now we're linked to the euro, so it could also be a euro stable coin, it would somehow have to be linked to euro, and which brings it back to a link to the central bank. Then if it's a euro CBDC, it would be somehow linked to the value that is controlled by the ECB. If it's a Danish stable coin, we would also think that we somehow would it would have to be backed by assets that would be stable in terms of Danish kroner. And if we see such an asset and it functions as money, we can use it for payments, we can use it for deposits. It would be very much like a bank deposit, but based on a different type of technology. And I think the direction we're moving in is that we would want to, if we have issues of such payment systems and storage of value, then we would want to regulate them in the same way that we currently regulate bank deposits. And I think that's also where we're moving. I don't know how fast that will go, but we have the MiCA regulation coming online soon in the EU. I think that's probably not going to be the whole response. There's a lot further to go. But if we have these private sector currencies developing, I still feel very confident that they will have to be rooted in current units of account. And that brings them into the ecosystem that we are controlling, that we have control of if you have a central bank that lives up to its purpose of stability.
So central banks will remain in control of the games. There are a few questions from Charles Cannon, from Brett Berger, on whether they will be too much in control. That's a debate which has been very much gone through in the last few months or even years about disintermediation, right? So Katie, I'm sure you have that every day, but how do you reassure people who say the banks are going to die because you're getting them out of business with the CBDC?
Yeah, so as the central bank, we have financial stability in our mandate. There's, that's something that we care a lot about. We did a discussion paper a couple of years ago about the impact of new forms of digital money on financial stability. So we've done a lot of analysis of this, and that analysis suggests it's all manageable. Analysis isn't, it doesn't reassure people all the time. So we have these limits in sort of proposed. The banks would like those limits to be lower, of course. Innovators would like them to be higher. I think what we do say, and I think maybe this speaks a little bit to what you were saying there, is it is our job to maintain financial stability. It isn't our job to protect the status quo. So I think whether a central bank digital currency comes along or not, there are other forms coming along, stable coins, etc. Banks will have to innovate, evolve, etc., whether or not a CBDC comes along. That's just part of, and they've been doing that very successfully for decades. So I have faith that they can manage it, and I have faith that the central bank would not write its own, death warrant in letting go of financial stability.
We have a question from Piroshka Nagy on the fact that, if I get the question right, the fact that many of the existing CBDC projects that have come to something concrete have come from countries where the central bank has credibility issues. She mentions Nigeria. That was before the change of governor, of course. So do you think that has kind of tarnished the brand of CBDCs, or is there an issue there that the fact that experimentation started in the emerging market space before reserve currency issuers, is that something that has an impact for retail users, or is that kind of an abstract concern? Maybe Katie first and then Sina.
Yeah, I think it is the case that we are all each sort of working to our own domestic policies, etc. But inevitably, the way people see it is shaped by which countries have introduced it. And so for us, there's a big sort of trade-off in how much public debate we want public debate, but as I say, we are not committed to introducing one. But we at the same, so I don't want to be out there telling people about it when that's the case, and yet I do want to ensure that the narrative is not driven by what's going on with the Naira or the yuan or even the sand dollar. These are each products that have been developed for their own domestic audiences. So I think there's we've got to be really good in our communication, in making sure we're communicating appropriately, clearly, make sure we understand what our narrative is. These things are really, they have the potential to really make a massive difference in how it's viewed.
Tina, on this, or any other concluding thoughts?
Only to say that I completely agree that that countries that already introduced CBDCs or different variants forms of digital publicly issued money, there are so many different reasons and so many different circumstances, and I do think that we should be careful to draw lessons from that. And just going back to what we already said, that it shows that uptake is hard, and I think that that's probably the only lesson that we can draw.
On that note, thanks very much to both of you. This was illuminating, certainly for me, I hope also for our audience. We'll have kind of summertime at financial statements. So one session in July, one in August, before resuming our usual pace of 2 sessions a month in September. On July 18, I will host James Fries, who has been the head of FinCEN, the Financial Crimes Enforcement Network in the US, also at the New York Fed and BIS. On August 9, we'll come back to the issue of supervisory lapses or perhaps failures in the US and how to look at it going forward with Mayra Rodriguez-Valladares, who has a stellar track record of helping US supervisors getting over their issues. And on September 6th, also looking forward to systemic risk with the one and only Charles Goodhart, who will I think provoke us to think a little bit harder about where the next problems might come from. Thanks again to everybody. I see a question from Pierre Rafi. The presentation will be put online as usual, hopefully later today, if Katie, you allow us to do that. Sorry, this is a bit of a forced exchange. I should have asked earlier, but thanks very much for that, and have a great rest of your day. Thank you.
Bye.